In this video, I explore and attempt to improve upon a popular day trading strategy called the London Breakout. Now, there are many different variations of the London Breakout, so you may or may not have seen the rules to the particular variation that I'm going to show you today. Firstly, I'm going to run an extensive backtest of the strategy in its original form using its original rules. Then I'm going to make some modifications, and some of those modifications actually end up doubling the average profit per trade. Stay to the end of the video to find out whether I would personally trade the London Breakout in its original form or even after some of the modifications, and find out why the London Breakout may not be the right strategy for you to trade, even though it does have a consistent edge shown in the equity curve. This strategy is purely a rule-based strategy, and a convenient one at that, because you only have to put your trade orders in once a day at the start of the London session. Rule-based trading strategies do appeal to a lot of us because, amongst other things, they do help take out some of the guesswork and the decision-making of a more discretionary approach. Okay, so let's talk about the rules of the London Breakout. Firstly, what we want to do is identify a session or a time period that we call the Asian session. The strategy is going to be for pound-dollar forex pair. And if we look here, we've got this lilac session. Now this is TradingView. You can put on this lilac session pretty easy. You need to add an indicator called sessions. You do that by indicators, search for sessions, and just add this sessions indicator, and that will paint the lilac session as the Asian session. Now the London session starts at 8 o'clock, so we're at 8 o'clock here and the London session is in green. So at 8 o'clock we want to look at the previous 10 hours worth of trading back to 2200 London time, and that is our Asian session. Hopefully, not to confuse you, I always use Eastern Standard Time when I'm doing any of my programming, so I'm actually going to be using the Asian session, which Eastern Standard Time is 3 AM back 10 hours back to 1700. Okay, it's exactly the same session, but I'm going to be calling it 3 AM back to 1700 the previous day. Once we have this session identified, all we want to look for is the high of the session and the low of the session. Once we've got the highs and the lows, mark them out. You can then box off the prices. So let's assume this is our Asian box. So this is going to be 2200 the previous day, and this is going to be 8 AM when the London session starts. So everything inside this box is going to be that Asian session. So we might have prices that jump around, and we're going to have our highs and our lows. From that we can calculate a midpoint through our Asian session. Now this is the important part. We've got this midpoint. Now on the open of the London session, if the prices here are above the midpoint, we're only looking for a short trade that day. If the prices are below this midpoint, we're only looking for a long trade that day. We know our prices are above the midpoint at the London open, 8 AM. Now all we need to do is put our orders into the broker to sell short if the prices come down and hit the midpoint. So the sell short order is at that midpoint level. The stop loss for that is going to be up here at the high level of the Asian session. And the opposite, of course, is for long trades. If the price at the London Open was below that mid level, then we put in a buy order to go long if it hits or comes up through that mid level, and then our stop loss is down here at the Asian session low. The exits we're going to use are just as simple as the entries. We're going to have 3 different exits. Number 1, we're going to be using a simple profit target, and that's going to be based on the risk. So we already know where our stop loss placement is going to be. We're entering at the midpoint, and our stop loss will either be the high or the low of the Asian session. Let's assume that the distance between the midpoint and the high or the low is 10 pips. The initial profit target I'm going to be looking at is a 1.3 reward to risk ratio. So if our risk is 10 pips, then our profit target is going to be 13 pips. I've chosen 1.3 because they're the rules for the strategy which I've already found. However, that might not be the best. So we're going to test different reward to risk ratios. Exit number 2 is a simple timed exit. If by the end of the session, which will be 2200 London time or 1700 Eastern Standard Time, if we're still in a trade, meaning we haven't hit the stop loss or the profit target, then we're just going to exit the trade, whether we're in profit or not. And exit number 3 is obviously going to be our stop loss. So we've got a profit target, a timed exit, and a stop loss. In addition to testing the standard rules which I've laid out, I'm going to make some modifications and try and improve the strategy. So the first test, and probably the most obvious one, is we're going to change that reward to risk ratio by changing the profit target. The second test will be removing that timed exit. Remember, I said if we haven't hit the profit or the stop loss within the session, then we're going to exit the trade at the end of the session, whether we're in profit or not. The third and the fourth tests that I'm going to test are looking at employing some filters for long trades and filters for short trades. Then for the fifth and the sixth test, I want to look at the size of the Asian session or the range of the Asian session. Remember the high and the low of the Asian session. So is it best only taking trades when the size of that session is at least, let's say, 10 pips or at least 20 pips? Is there a minimum size or a minimum requirement for that Asian session? And also look at the maximum. So is there a maximum? Let's say we can't trade. If that session is more than 50 pips, let's not trade. Can putting a minimum or a maximum on that Asian session improve the trades? Test number 7 is looking to delete our pending order to entry if it hasn't been hit or hasn't been triggered by a certain time. With the standard rules, I've left that to 1600 Eastern Standard Time, which is just an hour before the end of the session. So we've got that Asian range, and then if price just bounces around and doesn't hit that midline by an hour just before the end of the session, we're going to cancel the order because we don't want a trade that will only last a maximum of an hour. But can we reduce that right down even more? We might say, let's look at the Asian session, but only take the trades if it's triggered within the first 2 hours, or 3 hours, 4 hours, 5 hours. We're going to test that one. Test number 8 is looking at that start time, or looking at that London time I've mentioned. It's going to be 8 AM London time or 3 AM Eastern Standard Time. But is that the best time? Maybe 9 o'clock would be better, or 10 o'clock. We're going to test that. And the last test we're going to do is looking at the length of the Asian session. I mentioned that 8 AM London time, we look back at that Asian session, which lasts 10 hours. But is that 10 hours worth of prices the optimum? Perhaps we only look back 5 hours or 6 hours. We're going to test that too. Now we're going to look at the tests and the results of those tests. Now, I'm using multi-charts, which is the trading and testing platform that I use. And I'm performing these tests on data from January 2008 through to May 2022. And it's data that I got from Oanda. And all the tests are going to be using one standard lot, or 100,000 units. In this first test, we're just using the standard rules. So what I'm using is a 1.3 to 1 reward to risk ratio. We're exiting the trades at the end of the session, or actually at 16:45, which is just 15 minutes before the end of the session. And if the trade order hasn't been triggered, so the entry order hasn't been triggered, we're going to cancel it an hour before the session ends. So looking at the performance report, it's making $69,000. There's the equity curve, which is a nice equity curve. This is showing that this strategy or this idea has a consistent edge. We've got over 3,000 trades within that period. The size of the average trade is $22, but $22 is too small. And I say it's too small because I haven't included any trading costs within this test, or not yet anyway. I'm going to talk about that a little bit later. In real life trading, we have to pay trading costs at minimum in terms of the spread. And $22, we're not going to overcome those spreads. So at the moment, the $22 average trade is too small. So let's carry on to the next test. Let's look at changing the reward to risk ratio. And we're doing that by changing the profit target. So I've run an optimization called MyRR, or reward to risk ratio. And I've gone from 0.5 to 1, right the way through to a 5-to-1 reward to risk ratio. The previous test we saw was using 1.3, so in between 1 and 1.5, where we were getting between 45 and 53% profitable trades or win rate. Looking at the total net profit, we can clearly see that the larger the reward, the more profit we're making. And looking at the average trade value, the same applies. But when we are shooting for that bigger target, the winners or the win rate actually drops down. We're dropping down to 31%. So we know that a bigger reward to risk ratio will improve the strategy, although it doesn't bring up the average trade quite enough yet. The next test I want to do is switch off that timed exit or the exit at the end of the day. And I've got a trade here to show you. Normally, this trade here we've bought, normally if we weren't hitting the profit or the stop loss at the end of the session, we'd exit here at the end of the session. However, this time we're letting trades run overnight through into the next session. Now the results for this are using the 1.3 reward to risk ratio. We are making more net profit now. Equity curve is just as nice, if not a little bit better. And our average trade has gone up a little bit, but not much. In the next couple of developments which I've carried out, I've looked at having some filters for both long and short trades. I've looked at trend type filters, volatility type filters, but unfortunately I couldn't find anything that actually significantly improved the results overall. So I'm not going to show you the extensive testing which I've done, but I just want to say, unfortunately, just with the normal type filters which I find effective on most strategies, on this strategy I didn't find anything that worked well enough. So I then went on to look at the size of that Asian range, the distance between the higher the range and the lower of the range. I actually expected a smaller range or a narrower range to possibly produce better results. I thought if volatility had contracted and then we got a breakout, we'd get a relatively bigger move compared to that smaller range. So we looked at having a minimum range and a maximum range in terms of pips. But again, unfortunately, I didn't find anything which was significant, which was a real shame. Moving on to the next modification, this is looking at the end trade time is what I call it. At the start of the London session, we put in our order to enter a trade at the mid-Asian point line. However, prices might not hit and trigger us into the trade. At the moment, I'm saying we can get into that trade even if it triggers well into the afternoon or well into towards the end of the session. But I'm now going to look at restricting that. I want to say, let that order only be valid for an hour, 2 hours, 3 hours, and let's see what impact that has on the strategy performance. And I've put the information in a couple of bar graphs for you. First of all, we're looking at the net profit versus the end time. The standard strategy, the trades get cancelled at 1600 or an hour before the end of the session. Now we can see that cancelling the orders at 900 hours, that's Eastern Standard Time, is actually the best for net profit. Looking at the average trade, it appears that the longer we give the orders to trigger, the less the average trade, and the highest average trade occurs at 400. So what we're saying is we put the order in at 300 hours, which is the start of the London session, and then we cancel the order if it's not triggered by 400. So it gives us an hour for that trade to trigger. So I want you to remember the first hour as we move on to the next development or the next modification. And that next modification more than doubles the profit of the average trade. But before we do that, if you like this type of rule-based or mechanical strategy, then you should probably take a look at my 22-page Beat the Market Strategy Guidebook. And it's a PDF which lists out 3 more profitable or proven mechanical or rule-based strategies. And at the moment, if you use the link down below in the description, you can get it immediately and absolutely free. But better still, for those of you who already have the guidebook or maybe want even better strategies, then I've listed out 6 more proven strategies in my popular trading program. The strategies in that paid program can be traded manually or automated. If you're a multi-chance or TradeStation user, then I've even included the program code so that you can put it straight into your platform and then you can test it or even modify it or even trade it in an automated way, just like I do. More details on that program in the description down below. Okay, let's have a look at the most significant improvement to this London breakout strategy. Now, if you remember, we're going to be using an end time of an hour after the London session opens. So it's going to be 4 AM Eastern Standard Time or 9 AM London time. And then we're going to look at changing the reward to risk ratio. And I've gone from 1-to-1 all the way to 10-to-1 with the reward to risk ratios in steps of 1. And we can see that using 1-to-1 produces an average trade of $20, 2, 3, 4, 5, and we can see clearly the best number for the average trade is actually 7-to-1, very close to 5-to-1, and net profit is very good as well. It's the highest it's been yet, 108. So using a reward to risk ratio of 5-to-1 and only leaving our entry order in the market for 1 hour works the best. And look, it's doubled the average trade value at $53. So let's apply that and see how it looks in the performance report. We've got less trades, obviously, because we've only got an hour for those trades to trigger before we cancel the order. Average trade, we already know, is larger. The percent profitable is quite low because we're using a 5-to-1 reward to risk ratio. We already know that we're making 108,000. And the equity curve is fairly unchanged. It's still pretty nice. So limiting those trades just to that 1 hour is actually pretty more convenient for those of you who want to place trades manually, because you've only got to be at the chart for the open of the London session and then an hour later to see whether your order has been triggered or not. If it hasn't been triggered, then you cancel it an hour later using a 5-to-1 reward to risk ratio for the profit target. And I believe the average trade value has jumped up so much is because we've got opportunity to be in the trade that much longer. Now we're saying we need to be in the trade within the first hour, and then that leaves us the rest of the session, so a possible 13 hours for the trade to develop. We're looking to catch a trend, and the more time we have to catch the trend, then the bigger the trend we can capture. Well, so far, that's producing the best results, limiting to that 1 hour and using a 5-to-1 reward to risk ratio. I then continued more developments. Next, I looked at changing the start of the London session. So rather than using 3 AM Eastern Time or 8 AM London time, I looked at changing that. But much like some of the earlier tests that I was doing, I didn't find any significant improvement. The traditional London session open works the best. And then I looked at changing the duration or the length of that Asian session. So at the start of the London session at 8 AM London time, rather than looking back to 2200 hours the previous day, I shortened it. I looked back 1 hour, looked back 2 hours, 3 hours, 4 hours, all the way back. And again, I didn't find any significant improvement. So looking at that whole 10 hours actually worked best. Let's just do a quick recap then on the best rules so far for the London breakout. We found that using the regular start time for the London session works best. We've seen that in most cases, a 5-to-1 reward to risk ratio works best. If we aren't in a trade, if that order hasn't been triggered within the first hour, then we should cancel the orders because that gives us the best average trade value. And using that timed exit does work quite well too. You probably could squeeze a little bit more profit by letting the trade run into the next session. But then you've got things like overnight risk over weekends. And I know some of you prefer to just close out your trades at the end of the day. So for the little extra profit you get by leaving your trade running, it's probably not worth it. We've seen that these best rules have produced a net profit of $108,000 and an average trade value of $53. But unfortunately, although 53 is much more than $22, 53 still isn't enough to overcome some of those trading costs. And you want to be careful of this. You want to be careful when you're watching other people's testing. I've watched a lot of things here on YouTube, and quite often people don't include these trading costs. These are real life costs that you're going to know about when you're actually trading it with real money. Everybody is subject to paying spreads, and we get things like commissions and slippage on top. So the next thing I'm going to show you is what the impact is of those real life trading costs. In this workspace we have the original rules, and I'll just show you that the end time we're letting trades be triggered right up until 1600, an hour before the end of the session, and we're using a 1.3 reward to risk ratio. Let's just remind ourselves of what the equity curve looks like, and remember we've got our $22 average trade. Now I'm going to insert some trading costs. I'm just going to put a couple of pips worth of spreads in and out. So that's equivalent to $20 in and $20 out. So a total of 4 pips for the whole trade. Now let's look at the performance report. And that's what happens to an equity curve when a strategy has only a low average trade value. We look now at our average trade. We're looking at minus $9. So just those 4 pips worth of costs have actually destroyed this strategy. What a huge difference just those few pips can make. But you might say, yeah, okay, they were the original rules. What about the better rules? What about leaving the trades to trigger just for an hour and using a 5-to-1 reward to risk ratio? Well, let's try that and see what happens to the performance report. So let's change the inputs now. And a 5-to-1. We've still got our costs added here. And that's what the equity curve looks like. It's had some really good periods, but the rest of it is pretty much break even. Looking at the average trade value, it's gone from 53 now just down to 15. After running some extensive backtests and then going through a whole host of different modifications and improvements, we've seen what does and doesn't work. We've looked at changing the reward to risk ratio. We're doing that by changing the profit target. And we found out pretty much that mostly larger the better, anything up to about 5-to-1. We've had a timed exit at the end of the session if the profit or the stop loss hasn't been hit. And we found out by removing that, we can increase the profit ever so slightly, but it's negotiable whether it's actually worth doing or not. You didn't see all of them, but I actually ran some tests on some long and short filters to see if we could improve the trade that way. But we didn't find any significant improvement, unfortunately. I tried filtering the trades on the size of the range of the Asian session, but again, didn't find anything that worked well enough to use. Changing the time at which we cancel the orders if they haven't been fulfilled, or changing the end time, what I call it, that did actually make significant improvement. Using the base 1.3 reward to risk ratio, we found that cancelling orders by 2 p.m. did actually work quite well. But combined with a reward to risk ratio of 5-to-1, cancelling orders after that first hour definitely made most money. I then tried changing the start time of the London session and also tried changing the duration of the Asian session prior to that London Open, and both of which didn't find any improvements. But ultimately, even after the modifications which did work best, the size of the average trade was just too small. After trading costs, we wouldn't have been making any money, break even at best. And as far as the original rules, using that 1.3 reward to risk ratio, well, that will be just a money losing strategy. So the question is, would I personally trade this London breakout strategy? Well, I think you already know the answer. The answer is no. That average trade value is just too small. It's a shame because the strategy obviously has some sort of a decent edge. We can see that by the shape of the equity curve. But that edge is just not big enough to overcome trading costs in real life. I mentioned at the start of the video, there's many different variations of the London breakout. So maybe next time I'll test a different variation. Let me know if that interests you. If you have a different version that you'd like me to test, then also let me know. So I hope the information that I've provided you today has been helpful. If you've enjoyed the video, please do me a favour and hit the thumbs up button. And please subscribe if you don't want to miss the next ones. But until then, this is Jared Goodwin, and thank you.